One company that pays out big dividends is Altria Group, stock ticker MO, currently trading at $41.95 per share. Now, this company pays out massive dividends and has a forward-looking dividend yield sitting at about 9.34%. So this is one of the higher yielding dividend stocks that we typically look at. Now, we can see over the past year, the company's down around 5.73%, and over the past 5 years, it doesn't get much better, down around 23.88%. Now, to be fair, we have to keep in mind the company provides most of its returns in the form of dividends. So we don't want to just look at price return, we want to look at total return. So if we update this chart here, we can see Altria's total return versus their price return. And over the past 5 years, the total return looks quite a bit better, up around 11.09%, but that's still really underperforming the market. So what's the reasoning behind this? And it's really not a secret. We can see, according to the American Lung Association analysis of CDC data, cigarette smoking rates have fallen significantly for both youth and adults over the past 50 years. We can see in the 1960s, around 65, 1966, around 42% of adults smoked cigarettes. And if we look at where it ended in 2018, we're now at about 13.7%. So for society, obviously this is great news. This leads to a healthier society, but for Altria, this is not good for their business model. So what can they be doing to combat this? And this is something they've been talking about for a while now. We can see to address the evolving environment, Altria has been diversifying its product portfolio in recent years. We can now see they've already built up strategic positioning as a smoke-free player with offerings in e-vapor, oral tobacco, and heated tobacco markets. Now, I think this is a bigger deal than a lot of people realize because the US e-cigarette and vape market is expected to compound with an almost 30% CAGR by 2030. So this is massive growth in that industry. So Altria is definitely taking steps to address the declining smoking rates in the United States, which is a good thing. Now, the big problem a lot of people have with Altria Group isn't necessarily the stagnant share price performance, but it's the risk of a dividend cut. Lots of people are scared that this high starting dividend yield is not sustainable for the company. So let's go ahead and jump into my dividend breakdown sheet and start to address this. We'll come over here and plug in stock ticker MO and hit enter. And you can see all this data is going to automatically load in thanks to the help of the ticker data add-on in Google Sheets. And if you go to tickerdata.com at the link in the description, you can download any of my automated spreadsheets. Now, like we've already touched on, massive starting dividend yield sitting at 9.34%. And if we look at these payout ratios, you might think this is a pretty risky dividend. Look at the payout ratio here for trailing 12 months, 83.38%. and free cash flow payout ratio of 74.575%. Those are pretty high payout ratios, and we'll come back and talk about this in just a second. Now look at the yearly dividends. This company has done a phenomenal job of growing their dividends over the past decade, especially for being a dividend king. This is a company that's increased dividends for over 50 consecutive years. So when you consider that fact, they also have a 10-year dividend CAGR of 6.96%. Those are pretty impressive dividend metrics. High dividend yield, great history of increasing dividends with pretty solid dividend growth rates overall. We can see the 5-year a little bit slower at around 3.63%, but again, pretty solid considering the high starting dividend yield. So the big question is, these dividend metrics look good, but are those dividend payments sustainable with the current payout ratio sitting at about 83.38%? And here's what a lot of people misunderstand about Altria Group, and their management team has talked about this quite a bit over the past few years. Since 2010, Altria has targeted roughly an 80% payout ratio of earnings to dividends, among the highest in the S&P 500. So we have to keep in mind that 80% payout ratio isn't necessarily the result of poor earnings, it's actually the target from the Altria management group. They understand that the best way to reward their shareholders with their company is currently in the form of dividends, so that is exactly what they do. If we come over here and look at the free cash flow versus dividends paid out chart, we can see for the most part, their free cash flow is covering the amount they pay out in dividends every single year, with the exception of 2016. And speaking of free cash flow, we can see the company's done a decent job of growing their free cash flow to sustain those big dividend payments. In 2013, their free cash flow was sitting at about $4.2 billion, and look at 2023, a little over $9 billion. So again, that has allowed them to continue to grow those dividends at a pretty healthy rate. We can see a 10-year free cash flow CAGR from 2013 to 2023 of 7.92% and a 5-year free cash flow CAGR a little bit slower at around 2.2%. So when we look at the free cash flow payout ratio over time, we can see there was an unhealthy spike up in 2016, but for around the past 5 years, that payout ratio has stayed in around the same range, which is pretty much Altria's management's target. So while most people see these high payout ratios and immediately think red flags, I think we need to consider that this is actually part of Altria's management's plan. Now, while we're still on the topic of Altria's massive dividend at 9.34%, I want to talk about how you can double your money with Altria Group, and this goes back to something called the Rule of 72. Now, the Rule of 72 is an easy compound interest calculation to estimate how long it will take to double your money. Now the idea behind it is if you take 72 and divide it by your interest rate, it will give you a rough estimate as to how long it will take you to double your money. So you can see, for example, at a 2% interest rate, your money would double at around 36 years, a 4% interest rate 18 years, a 6% interest rate at around 12 years. And considering Altria currently has a starting dividend yield sitting at about 9.34%, we can make the assumption, according to the rule of 72, that we would be able to double our money with Altria's dividend payments in around 8 years, maybe even a little bit less, since 9 times 8 is around 72. So the rule of 72 gives us an interesting perspective as to how long it would take to double our money with Altria's dividend. Now, if we keep moving forward, there's some other metrics that I want to look at for Altria, so I'm going to jump over to this stock screener, plug in MO, and hit enter. And again, you can download any of my sheets on tickerdata.com at the link in the description. But okay, right away, we can see there's a lot to point out here. Now, the first thing is revenue per share. It's not necessarily growing at a high rate. We can see in 2013, it was around $8.84, and it slowly but steadily grew all the way to $11.54 in 2023. So not necessarily massive growth, but top lines are growing overall. We can see the same is true for free cash flow per share. Now, there's one metric that I really want to talk about, and right here we can see it. It's shares outstanding. And we can see shares outstanding for Altria Group have been declining over the past decade. And Altria actually recently announced that they're planning on buying back even more shares, around $2.4 billion worth of its stock. So I want to take just a moment to talk about how buying back these shares can affect the company, especially for a company that pays out massive dividend payments. So let's have a quick share buyback lesson. I'll go ahead and zoom in, and we're going to look at a quick example. Let's look at an example of a company that currently has 1,000 shares outstanding in 2023, and in 2023 paid out total dividends of $5,000. Well, based off this information, we can find out how much they paid out in dividends per share. It's a pretty simple formula. We're just going to take the total amount they paid out in dividends and divide it by shares outstanding. So we can see in this example, this company would have paid out $5 per share in 2023 in dividend payments. Now let's make the assumption that the company also buys back 10% of its shares in 2023. So now instead of 1,000 shares outstanding in 2024, this company has 900 shares outstanding. So even if they paid out the total amount of dividends, we can see this plays a major role in how much the company pays out in dividends per share. So this company would have a dividend payout per share of $5.56, even though it didn't technically pay out more in dividends from the company perspective. So again, even without increasing their dividend payments, simply by buying back shares, we can see the dividend had a per share increase of 11.11%. So share buybacks can play a major role in allowing companies to continue to pay out more in dividends per share every single year. So when we see Altria continuing to buy back shares, this should make you feel even better about the safety of those dividend payments moving forward. So with all of this being said, is Altria Group a good stock to consider buying at $42.01 per share? Is it trading at a good value? So to answer that question, let's go ahead and jump into my stock valuation spreadsheet, and I'll come up here and plug in MO and hit enter. And again, you can see all this data will automatically load in. Now, it's worth pointing out the company's beta is sitting at 0.7, so you should see pretty low levels of volatility, generally speaking, with this company. Now, let's go ahead and jump into our first valuation, which is going to be Graham's valuation. And this is a valuation model invented by Benjamin Graham. And the general idea behind it is we should be able to value a company based on how much their earnings are growing and based off of current market conditions, which is why the current yield on AAA corporate bonds. So the first metric that we need is our estimated earnings per share average. Now, there's obviously multiple places that you can find this number, but using the ticker data function, we can actually find multiple analyst expectations for this company. We use equals ticker data, click MO, we'll come up here and select estimated earnings per share average, and then just select 2024, close this parentheses and hit enter. And we can see, according to analysts, the estimated earnings per share average in 2024 sitting at about 5.02. Now, if we jump over to Seeking Alpha, we can see their expectations are slightly higher than this, so I'll go with a number just a little bit above this at around 5.05. But we then apply our growth rate projection, which is relatively low for Altria. We then multiply by 4.4, which is the average yield of AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds, sitting at 5.16. Now, this is quite a bit higher than it has been over the past 5 to 10 years, and this will drive down this valuation quite a bit. But once we plugged all this in, we come to an intrinsic value of around $43.06 per share, which is actually pretty close to the current trading price for this company. Now, the next valuation we're going to go ahead and look at is going to be our discounted cash flow analysis. And basically, we're valuing the company based on how much free cash flow they're going to produce in the future. So we need to project our growth rate to the future free cash flows of the company, and I'm going with a growth rate of around 2% for those future free cash flows. We then find the present value of those future free cash flows and add them together, add the company's cash and cash equivalents, and subtract out their total debt to get their equity value. We divide by shares outstanding and come to a DCF price per share of $61.57. Now, typically the next thing we look at is the multiples valuation, but I don't really think this is a fair valuation in the case of Altria Group, so we're not going to use it. So that means the last valuation we're going to use is going to be our dividend discount model. And basically what this does is it values a company based on how much they pay out in dividends and how much that dividend is increasing. So we can see the dividend payouts for this company over the last few years and the dividend growth rates. It has an average growth rate of around 3.6% over the last few years, and moving forward, I'm projecting a dividend growth rate of around 2% and a discount rate of around 9%. So considering these factors, we come to a dividend discount model price per share of $57.12. So when we jump over to our output tab, I'll zoom out just a little bit, we can see the three valuations that we used. We have grams at 43, DCF at 61, and dividend discount model at around $57 per share. So when we average those three together, we come to an intrinsic value of $53.92, which is actually quite a bit higher than the current trading price for this company. So with a 10% margin of safety, you could see our acceptable buy price at around $48.52, and with a 20% margin of safety, acceptable buy price pretty close to that current trading price at around $43.13, meaning we are getting a buy signal. Now, in my opinion, this is a company that pretty often trades below its intrinsic value for a couple of different reasons. In my opinion, I think there are a lot of investors who have pretty big concerns about smoking rates declining, which is understandable, and they also have a lack of confidence in this company being able to translate and diversify into other industries. And so while I think the dividend is safe as of right now and sustainable, if the company does fail to continue to grow revenues and free cash flow, then at some point down the road, maybe 5 or 10 years from now, that dividend could be at risk. But as of right now, when I look at these dividend metrics, it really does appear the company is exactly where they want to be. They've been paying out massive dividend payments for over 50 consecutive years, and the payout ratio is right at their target range. And there are a few other key risks we have to consider when looking at Altria Group, and this is something I was actually writing on Seeking Alpha just about the other day. If we zoom in just a little bit, there's two main points I want to point out. First, there are significant federal, state, and local government actions that could be difficult and costly for Altria to manage. And then it's also worth considering that tobacco products are subject to substantial taxation, and potential increases in taxes could reduce Altria's profitability. Now, speaking of profitability, if we jump over to my profitability spreadsheet, we can see over the past decade, Altria's profitability has actually been increasing. They have a 10-year average gross profit ratio of around 62.7%, and in 2023, their gross profit ratio was close to 70%. So in that sense, this company's actually done pretty well. So with all that being said, I personally think Altria is trading at a decent value for investors looking for immediate big dividend payments. Now, I don't think you'll see a lot of share price appreciation in the future, and I don't think the dividend growth rates will be high in the future either. But with all that being said, go ahead and let me know what you think of Altria Group in the comments down below if you plan on buying or selling. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets, then you can head over to tickerdata.com at the link in the description. So with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.